In this video, we are going to walk through an exercise that is set up identical to exercise 3-1 in your textbook. So it'll have different numbers, but you can use the exact same approach that I'm going to show you here to solve exercise 3-1. So let's start here. They tell us on January 1st, year one, Jana started a small flower merchandising business that she named Jana's Flowers. The company experienced the following events during the first year of operations. Now, our first task is going to be to show the effect of these events on the accounting equation. And they give us an expanded accounting equation, which we'll look at in just a moment. But they give us 5 different transactions. So what we'll do is we'll go through those one by one and we'll look at how they affect the expanded accounting equation. Okay, now we know that the accounting equation basically says assets equal liabilities plus equity. Okay, in this case, they just left out liabilities because this company doesn't have any liabilities, but you can kind of pretend that plus liabilities of 0 is in there if you want. And so in this case, their assets are actually going to equal equity over here because liabilities are 0. And if the transaction affects retained earnings, we are going to indicate which account, and that's going to be important when we put together the financial statements. All right. So let's go through each of these. Okay, so she started the business by issuing common stock for $10,000 cash. The effect of that on the accounting equation is cash is going to go up by $10,000 and common stock is going to go up by $10,000. Now, again, your numbers are going to be different, but the process is the same. So whatever you're given for the issuance of common stock, you're going to increase cash and increase common stock. Then we're going to go to the second transaction. Paid $7,000 cash to purchase inventory, okay? In this case, you're going to decrease cash for the amount that was paid for the inventory, and you're going to increase inventory by the same amount. Transaction 3, sold merchandise that cost $4,000 for $9,000 on account. Now here we're actually going to have 2 entries that have to be made. Anytime we have a sales transaction, we're going to have 2 pieces. We're going to have one, the first part is the sell piece. That's where we're going to record the sales revenue based on the selling price. The second piece is where we're going to record the cost of goods sold and relieve the inventory based on the price that we paid. Okay? So the first piece of this transaction is recording the sales piece. Now they tell us that it was made on account. When you see something that says on account, that is a red flag that it is an accounts receivable. So we are going to increase accounts receivable for $9,000, and we are going to increase retained earnings for $9,000. And the account title here is sales revenue. And again, that is based on the selling price of the merchandise. Now, her cost for the merchandise was $4,000. Therefore, that's the amount that we're going to use for the second piece of the transaction where we relieve the inventory and we record cost of goods sold. So we're going to decrease inventory $4,000 and we're going to decrease retained earnings by $4,000. And the specific account is going to be cost of goods sold. Now we go to transaction 4. Collected $8,000 cash from accounts receivable. Okay, we collected the cash, so we're going to increase cash by the amount of cash that we collected, and we're going to decrease accounts receivable by the same amount because those people no longer owe us the money. All right, last one. Paid $2,000 for operating expenses. All right, we're going to decrease the cash account for the amount that we paid for the operating expenses. We're also going to decrease the retained earnings account, and the account title is going to be operating expenses. Okay? Now, once you complete this section, I want you to make a note of these balances because you're going to need them for the next part of the assignment. Okay? So now we're going to hop over and we're going to prepare an income statement. Okay, well, the first thing that we have to remember is an income statement only includes revenues and expenses. Those are the only things that we're going to have on an income statement. Okay, so when you're completing your problem, Your sales revenue is going to be whatever amount you see here. That is the sales revenue on account. Okay, in this case, on the problem that I'm working, it's $9,000. Whatever you see here, that's your sales revenue. Minus cost of goods sold. That's going to be whatever amount you have here, the cost of merchandise that was sold. Gross margin is then the sales revenue less the cost of goods sold, gives you your gross margin. We then subtract operating expenses. That's whatever amount you have right here, and that gives you the amount of net income. Now we're going to hop over to requirement B2, which is preparing a balance sheet, okay? And this is where it's really going to be helpful to make a note of those balances from requirement A, because here's what I want you to notice. All of these balances that we have listed are coming directly from the balances that we have here, okay? So just make note of whatever your balances are for each account, and then you can hop over here and you can just plug those amounts in for cash, accounts receivable, inventory, common stock, and retained earnings, and then you can compute your totals just as they've done here as well. All right, the last thing you're going to do is we're going to hop over here to B3, and you're going to do the statement of cash flows. And you'll set up your format for the statement of cash flows just like what we have here. Okay, and so now we're going to look back up at these transactions, and we're going to determine what we need to put on each line. So the inflow of cash from customers, well, that's going to be the $8,000 in cash that we collected from customers. So that's a positive $8,000. If it's an inflow, it's positive. If it's an outflow, it's negative. All right. Outflow for inventory, $7,000. That's the amount that we paid to purchase the inventory. Outflow for expenses, $2,000. That's the amount right here that was paid for expenses. Okay. We add all of those together, and that gives us the net cash flow from operating activities. Now, in this specific problem, we don't have any investing activities. Remember, investing activities are those activities involving not only investments, but also long-term assets like property, plant, and equipment. In this case, we didn't have any of those transactions. But we did have a financing activity. Remember, financing activities involve long-term debt or equity. In this case, the business was started by issuing stock. So we got $10,000 as a cash inflow from the stock issuance, which gives us our net cash flows of from financing activities of $10,000. We then add all of our cash flows together, and that gives us a net $9,000 for our change in cash. And we'll notice that that ending cash balance of $9,000, it agrees to what we have over here on the very first tab for our balance in the cash account. And I'll let you guys figure out part C on your own.